Good morning, everybody. Welcome to the weekly general update for the 22nd and 23rd of October. And markets are still at a pretty knife edge situation. We saw a really good breakout on the S&P index on Friday night, and we'll have a look at that chart in a minute and try and make some sense of this current market movement. So first of all, just a quick reminder that this is general advice only, so all this information you need to weigh up against your own trading plans. So the action for the week is a summary. The S&P index finished about 1% higher for the week after being down for most of the week because it had a pretty strong finish last week and again this weekend. We did get a breakout from that little consolidation period that we had, which lasted for about 7 days. And you've really got to see in the short term that breakout is fairly bullish, even though markets do have a habit of turning around immediately after they've broken out. But I think if we do get a bit of a turn back, it'll only be fairly minor. So I am expecting to see the S&P index push higher from here at least for maybe another week or maybe 2 weeks, and then from there we'll have a look at the bigger picture on the charts. So we could be seeing the start of a new bull market. I personally, from a fundamental point of view, it makes absolutely no sense to me at all, and I believe that the odds are more heavily in favour of us getting a more significant correction rather than the start of a new bull market. But you never know, and particularly if there's a very substantial amount of money printing in Europe and in the US, then markets could react in the same way that they did from August of last year when Bernanke first started QE2 and head a lot higher. So the initial target that I think is probably going to be reached is 1257 on the S&P, which is another 20 points higher than where it finished on Friday night, with the possibility of even pushing a little bit higher, and I've set some maximum target levels. The ASX 200 closed a little bit worse for the week. It was down 1.5% on the week, and it's really the China factor. There's so much discussion and things being written now about the China property bubble bursting, and that really is weighing on resources. The incredible thing for me, though, is that resource stock prices have been held back because no one was believing the current commodity prices were sustainable. So there's been no upside in the stock, and yet as soon as the commodity prices start to come off a little bit, then the stock prices fall dramatically. So, there's things here that are just making absolutely no sense at all. Now, the Shanghai Composite had a partial break of support, and that's really a bad sign. So I want to have a look at that chart as well, because that's certainly not a good sign for our market, or certainly for the resource section of our market. Gold closed lower, $40 on the week, even though it did rise on Friday night. So this is all still part of a big basing pattern for me that is probably somewhere between 1550 and 1750, and could well play out over another 3 or 4 months yet. We had such a big run up that to get a pause of that duration, something of the order of 6 months, would be pretty normal. But there were some very positive developments with respect to gold, and I wrote about that in the alerts, with the establishment of a new bullion exchange in Hong Kong, which is basically pricing gold in Chinese yuan. Silver was $1 lower also on the week. So we'll just have a quick look at strategy before we get onto the charts. Not a lot has changed here with stocks. Whilst I think the odds heavily favour a bit more upside, I don't think there's a lot in it, and therefore I don't see the point in taking a lot of risk on being long the market at the moment. So outside of a small selection of gold producers, I really think that we don't want to be holding very much in terms of long exposure to the market, because the reversal if and when it comes, I think will probably be fairly abrupt. So I just don't see the reward for the risk. There's not enough upside to warrant the risk. And also with this upward momentum, we don't really want to be shorting at the moment either until we get some signs that maybe this little section of the market advance has run its course. So I really want to hold fire on shorting. So I guess the bottom line is, at the moment, it's pretty much keep your hands in your pockets for another week or two, and let's identify a better risk reward entry point. Now, just a bit of a heads up, this is not ready for release yet. There is a group of members who are part of our live trading room who are live trading a metals and index trading system that we did quite a lot of testing on and produced some pretty robust results. It's a almost totally mechanical approach to trading. It's quite short term. Trade lengths typically from 8 to 10 hours through to maybe a week at the most. It's very much a short-term cash flow trading situation, and which I know will appeal to a lot of members. And so far the results are just simply outstanding. We're getting really good ratios in terms of winners and the other ratios that we look at. And the fact that the trades are fairly short term means that we're getting a lot of turnover. So if we can hold the results, if we can continue these results for a longer period of time, then we'll be looking at releasing it to the general membership. And it's one that I think has got a lot of potential. Some of the other aspects of it, there's obviously zero brokerage, and you can use quite low risk per trade levels. So I think it is potentially something that's going to be of great interest to members. And just finally, looking at gold and silver, really nothing has changed there. I'm not in any hurry on precious metals on the ETFs to add to our position, because I really think we're going to see a little bit more of an extended sideways movement in the actual physical gold and silver itself. However, still looking to accumulate gold producers progressively, although we've got a few now, so I'm pretty reluctant to add a lot more to it. But look, if we do get a sharp sell-off and we can buy good quality gold producers at even cheaper levels than for now, I certainly will probably be looking at doing that. So that's a bit of a summary. Let's have a look at the charts. So we'll start first of all with the S&P 500, and you can see that we'd had about a 7-day, I'll just tighten in on here, had about a 7-day consolidation period. So the market rallied very strongly off these lows on the 4th of October, and we then had this consolidation period from the 12th of October until Friday night, and we then got a solid move higher in the US market to break out above that 1230 area. So I think we're now heading for 1257, which is the 61.8% retracement of this whole move, which started on the 29th of April and ended down here on the 3rd of October. So I think we'll probably get to that level. There is a higher Fibonacci retracement level that sometimes comes into play, and I've set that at 1301. So if we do go through 1257, then I would see 1301 as probably being about as far as this rally would run. Now I don't expect that it will go there in one go. In fact, I'm not really expecting that we'll move directly to 1257. I think it's possible we might take a few more days or a week or so to actually get to that level. Following that, as I've been writing over the last couple of weeks, there are two scenarios. One is that this leg from the 4th of October higher is the start of a new bull market that could carry us back up, certainly to the April highs of 1360, but possibly to the highs here of 2000 and 2007, which is up at about 1550. Now, from a fundamental point of view, I think there's very little chance of that happening. However, this has been such a powerful run, and with the distinct possibility of significant money printing in both Europe and in America, then I think you've got to acknowledge that that is a possibility. But there are so many problems in Europe that I can't see it, but I'm at least open-minded to the fact that that could be a possibility. The scenario that I favour more, though, is that when we complete this run higher, whether it's to 1257 or somewhere a bit higher than that, that we do then get into a more significant decline. And there's actually some fairly close correlation between what we saw in 2007 and 8 and where we are now. So I'll just run through that, and hopefully this chart's not too messy for you, but in 2000, starting in 2007, so October 2007, we started a decline, a 5-wave decline, and so we had 1 here, 2, 3, 4, 5. So we completed five waves of price action to the downside. We then had a relatively short rally that went up to a peak in May of 2008, and then we resumed the downtrend and really got into the main body of the GFC in 2008, and we had 5 significant waves to the downside. So that's pretty normal in normal market patterns, where you have 5 waves in the direction of the main trend, and my basic premise is that we're in a bear market, and that bear market could last for another 3 to 4 or even 5 years, and within that we'll have some pretty good bull markets that are very tradable, but overall, bigger picture, I think we're in a bear market. So it makes sense to me that we've got 5 waves to the downside and 3 waves to the upside in a more minor correction against the main trend, and then we resume the downtrend. This was 5 waves to the downside. We've now had a very significant correction of that move, and I must admit, the higher that it goes, the less likely it is that we're going to get a significant move back down, but there certainly are some similarities with 2008, and I guess whether it plays out in a 2008 style or not will depend a lot on the political decisions taken in Europe. So I still think we've got 2 distinct possibilities. Now let's have a look at the other markets. So we'll look at the Australian market. You can see here we had a significant downtrending channel. Our market managed to break out of that on about a week or 10 days ago, but it's just rolled over again. Now we will be up on Monday, probably just up under 4,200, but what is weighing on our market, of course, is what's going on in China. And if we have a look at the Shanghai index, let me just pan back, you can see this level here at 2320 was a very important level. It defined several tops and bottoms in the market over the last couple of years. We've definitely got a downtrend. You can see there's the red 50-day moving average is clearly and strongly pointing down. The market managed to rally a little bit a week ago, but it only managed three days up, and now we're back down again, and you can see Friday actually closed at its lowest level since that is the lowest level that it's closed at since February of 2009. So that is quite a bad sign and not good for our market, which is another reason why I don't want to be doing too much with resource stock, non-gold resource stocks. So I think that will be the thing that will weigh most heavily on our market. It'll be obviously interesting to see what happens to the Shanghai index over the next couple of days, so I'll be watching that one quite closely. So that's it for this week. Oh, sorry, we'll just have a look at, forgot, we should have a look at gold. So here we go with gold. We'll just pan back. Massive run from October '08. The price got way above the moving averages, particularly the 150-day moving average. Went parabolic for a while. We've pulled back to the moving average now, and a consolidation of 3 to 6 months would not be unusual. We've done the peak up here was September, so we've already done a month and a half of this. I think we've got a few more months to go yet. And we'll just finish off and have a quick look at silver, and the pattern is very much the same. Big decline, and we're just getting a consolidation pattern at the moment, which is between around about $28.50, $29 and about $33. So that's the range there, and on gold it's between about $15.50 and $17.50. So there's an opportunity there for us to maybe do a bit of short-term trading in both gold and silver as well, just basically trading that range. So that's it for this week. We'll catch you again next weekend. Cheers.